There are people walking around with an 800 credit score and a negative net worth, and there are people with a 640 credit score who are quietly building real wealth. The number you've been obsessing over doesn't measure what you think it does. Here's what nobody tells you when they hand you the good credit checklist. Credit scores were not invented to measure your financial health. They were invented to measure how reliably you borrow money and pay it back. That's it. It's a metric created by lenders for lenders to help banks figure out how much risk they're taking when they lend you money. Not how much money you have, not how smart your financial decisions are, not how close you are to financial freedom. Just, does this person pay their debts on time? And somewhere along the way, that lender metric became the thing millions of people use to measure their own financial worth. And in a minute, I'll show you exactly how that confusion is actively working against you. Let's look at what actually goes into a credit score. Payment history, that's 35% of your score. Credit utilization, 30%. Length of credit history, 15%. Credit mix and new inquiries, the rest. Notice what's not in there. Your savings, your investments, your net worth, your income. You could have $200,000 in an index fund and a 620 credit score. You could have $0 in savings and an 800 credit score. The score doesn't know. The score doesn't care. It's measuring one very specific behavior. Do you use debt and do you pay it back on schedule? So how did we end up treating this one metric like it's the ultimate measure of financial responsibility? 2 reasons. First, the credit score is visible and easy to track. Mint shows it, your bank app shows it, Credit Karma shows it. Your net worth, most people don't calculate that. Their investment growth, too abstract. So the score wins by default. It's the thing you can see, so it's the thing you focus on. Second, the financial advice industry has an incentive to keep you focused on it. Credit cards, loan products, mortgage refinancing, all of it flows through your credit score. The more you optimize for credit, the more products you're in the market for. Your credit score being high is good for companies that want to sell you debt. That's not a conspiracy. That's just how the incentives line up. And in a minute, I'll show you the specific ways. Optimizing for credit can actually hurt your real financial position. Here's where it gets concrete. People reject 0% financing offers because they don't want a hard inquiry. A hard inquiry drops your score by maybe 5 points temporarily, but they're walking away from free financing on a purchase they were going to make anyway. People keep zero balance credit cards open for years to protect their credit age and utilization ratio, but they're paying annual fees or they're keeping mental bandwidth on a card they have to track so it doesn't get flagged as inactive. People delay closing old accounts because length of credit history. Even when those accounts have fees or are attached to a bank they no longer want a relationship with. All of these are real trade-offs. Real money, real time, real cognitive load spent optimizing a score that measures how good you are at managing borrowed money, not how wealthy you are, not how financially secure you are, just how good at debt. Here's the thing about credit scores. They matter. I'm not telling you to ignore yours. A good credit score lowers your interest rate on a mortgage. Over a 30-year loan, that's potentially tens of thousands of dollars. That's real. But there's a difference between I maintain a solid credit score as a tool and I optimize my entire financial behavior around keeping this number high. One is using a tool, the other is serving the tool. The most financially healthy people treat credit score the way they treat their car's check engine light. You want it off, you glance at it occasionally, but you're not thinking about it every week, and you're not making every driving decision based on what keeps that light off. Your actual financial dashboard, net worth, savings rate, investment returns, cash flow, that's what determines whether you retire with money or work until you can't. Credit score is a small instrument in the corner, useful, not central. So what changes? First, stop checking your credit score more than once a quarter. Seriously, once a quarter is enough. Weekly check-ins serve your anxiety, not your finances. Second, when you're evaluating a financial decision, ask the credit score question last, not first. Does this decision make financial sense? Does it align with my actual goals? Then, and only then, how does it affect my credit? Third, move your attention to the number that actually matters, net worth. assets minus liabilities. Track that monthly. That's the number that tells you if you're moving in the right direction. An 800 credit score and a negative net worth means you're excellent at managing debt and losing the financial game. A 680 credit score and a growing investment account means the score is doing its job. Just a tool in the background while you're actually building something. If this reframe hit, you already know the pattern. Every video on this channel is the same move. We take one thing you were taught is the goal and ask, is this actually getting you where you want to go? Next time, we're going after something that sounds even more responsible. Something personal finance Twitter has turned into a religion. And it might be the biggest reason you feel stuck. That video is coming up next.